Um, all right. Then let's talk about chapter 8. So last class we had a kind of social experiment in our class, and we checked our preference toward investing for the future. And we did this kind of experiment with thinking about the gamble, and we had 4 questions, and let me explain what they mean. So first, we were comparing the 2 gambles, and generally people prefer the second one. As you can see, this is the result from the Google, and as you can see, 95% of you students here, classmates, are choosing the second option, where you receive $30 if you get the head, and you will receive $10 if you get the tail. And the reason can be this. So we think about the expectation, what we usually get on average, and then the expected value can be calculated by considering the probabilities and then the outcomes. And here, for each outcome, we have gains and we have losses, because we need to pay $10 if we start to gamble, and then we will get 20 or 0 depending on your outcome. So this is the probability, 50-50, and then the expected value was 0 for the first case, while in second gamble we have an expected value of 10. Therefore, we can see that generally people prefer to have a higher expected value. But in the second question, we are in a trouble, because now the expected value cannot explain our result. So in the second question, we are comparing another gambles, and this is the gamble we had chosen in the first question, and this is the new thing. And now in the third gamble, you will get $40 if head comes up, and you will get nothing if tails are coming up. So statistics from the class shows that 3/4 of students are choosing the original one, where you receive 30 or 10 depending on your outcomes, compared to you get 40 or 0. So this can be explained intuitively like this. So as someone told in the last class, we will get at least $10 in the first case. However, in the second option, we will lose everything if tails comes up. So therefore, we prefer the first one. And this can be explained mathematically by applying the concept of the volatility. So here the volatility is statistically, it means the standard deviation or the variance. So this is how much extreme values you usually obtain. So if your results, if your outcomes are generally concentrated around your expected outcome on the average, then you have a low volatility. While if you get some extreme numbers, either way, positive, negative, then you have a higher volatility. So by calculating the standard deviation, we can see that the gamble 2's standard deviation is $10. On the other hand, the standard deviation of the third gamble is 20. So it has a double standard deviation compared to the previous one. It means it is likely that you will get more extreme values. So you get either 40 or 0, and this is more extreme compared to 30 and 10, right? So therefore, you would like to have a low variance or the low standard deviation in this investment. So far, we found that generally people prefer an investment with a higher expected value, And second, they prefer an investment with a low volatility. However, and this is the general case, so in most of the people, they are making decisions based on these two criteria. However, this is not always true. So the next two questions are about some weird cases. So in the third question, now we pay certain money and then we flip a coin. And in the game book 2, this is the previous version, so we pay $10 and in head we receive 30 and in tail we receive 10. However, another option is that we need to pay not $10, but we have to pay $1,000. And then if heads comes up, and then we will get $1,030, while we will get $1,010 if tails are showing up. And then the results are not, you are not choosing the only option here. So you have options, you have opinions split it into two pieces. So half of the students are trying to choose the first, less than the majority of students are choosing the original gamble, while slightly larger than the majority of students are choosing the second one. So can you explain why? I think it is important. It is not possible to explain this result with the expected value, because actually, if you calculate the expected value of gamble 2, we had $10 as the expectation, but the new gamble, the expectation is 20. Therefore, if we are really making decisions based on the expectation, then we should all have to choose the new option. However, this is not. And that is because now you are afraid of investing $1,000. So we can just slightly think about the rate of return. So the expected return of the original gamble is 100% because you put $10 and then you may get 30 at maximum and you will get the original money principal. So generally, you are going to have a 100% return. However, the expected return of the new gamble is lower. So you need to put $1,000, and this huge investment makes your rate of return smaller, even though the absolute value is larger in this case. So therefore, we have two things to be noticed here. First, sometimes people make decisions based on the money they have. So in this case, we do not want to have the new option because we are feeling uncomfortable that we have to put $1,000, not $10. And this is the point. And the second point is that sometimes people make choices not based on the absolute value of expected value, but they are making decisions based on the rate of return. As we have learned from the last chapter, that sometimes people in the field, industries are preferring internal rate of return methodology than the net present value approach. And finally, we have the last question. So now, still we have the original option we chose, and the new gamble number 5, is you pay $10. This is the same. However, you will receive $100. So this is huge return, and then there is a penalty. So you have to pay 60 if the tails come up. Therefore, it is a more extreme case. And then if we are making decisions purely based on the expected value and the volatility, then you have to choose this one. However, not all people are choosing this. So you can see that actually still 25% of students are choosing the second option. And this is even larger than when we compared two gambles with the same expected value, but with a low volatility and a higher volatility. So in this case, in the second question, 22.5% of students have chosen a high volatility investment. Now, more than 22.5% of students are choosing high volatility. So this cannot be explained by the volatility. And we say that they are crazy. So this one shows that actually sometimes people are not rational, and they likely to make decisions just for fun, to enjoy some of the gamble. And therefore, our conclusion is that generally people prefer higher expected value, and they also prefer low volatility, but sometimes they have some weird decisions, such as making decisions based on the ratios, not the values, making decisions based on their possessions. So if they have a lot of money in their pocket, then they are generous. And then if they have no such big money in their pocket, then they are very careful. And finally, they may take risky decisions just for fun. So this is our conclusion about the people's preference toward investments. And based on these findings, we are going to think about how to incorporate the uncertainty or the risk into our investment criteria. So as we can see, if you have two investments but with the same expectation, people try to choose one with low volatility. And this can be explained by the risk aversion. So here the term risk, it often comes from a finance course. And this is about the uncertainty. So in the future, you may get some unexpected situations, and they are all called the risk. So the risk is defined as the uncertainty in investments that potentially affects the investor's welfare negatively. And we find that we usually observe that people try to avoid risk. People don't like risk. People do not enjoy uncertainty. They want to have a assured, expected situation than to have some uncertainty. So this kind of tendency is called risk aversion, and it generally applies to most of the people. Of course, we have some exceptions, and then there are some certain people who like to have more risk in their lives, and generally they are some entrepreneurs, some founders of the companies, and it is known that they are psychopaths. So they are very good at managing a firm because they try to seek some risk, and they are very courageous to take certain uncertainties. However, they are not good in their personal lives anyway. So we are considering about normal people, and because normal people do not want to have a risk aversion, now we have a principle called risk-return trade-off. So in finance, everything is a trade-off. So when you make a decision, then you are giving up other options, so you have a trade-off, and investment is the same. investment, it can be said as this one. You have present and you have future, and now you can consume your current possession today. However, for some reason, now you don't want to spend the money right now, but you are thinking about the future and you put your money on something. And then in the future, you have return. So in this point of view, the investment is a trade-off. So whether you want to have a consumption in present or whether you want to have a potential return in the future, it depends on your decision. But now you have to trade. So you can only have one. You can have a consumption or you can have a future return. So this is called the trade-off. And think about the future. The basic fundamental characteristic of the future is that this is uncertain. So of course we are trying to make some analysis and we try to guess about the future and to predict it correctly to try to reduce the uncertainty. However, in any case, we still have some unexpected situations in the future. Therefore, by trading off your consumption today, you are saying that I'm going to take this uncertainty. And that's the problem, because generally people do not like to have uncertainty in their lives. Therefore, if you are giving up some consumption today and then you are going to have a future return, then this return should be higher than your consumption level today. So you are going to argue that, hey, I'm giving up today's enjoy and then I'm trying to prepare for the future. So there's no reason that I'm going to do that if I'm going to get the same return from today. Therefore, the return should be higher, and this is due to the uncertainty characteristic in the future. And therefore, similarly, we can extend this kind of logic further. So if you have more uncertainty, then you will demand more return from your investment. So for example, if I have to spend $10 to invest in a stock, then I generally want it to be like $20 per share in the future. And there is a possibility that sometimes the firm can be very successful, so the stock price skyrocket, or sometimes it can go crash, so maybe the stock price can be $5 tomorrow, so there is uncertainty. Therefore, I generally want to have a higher return from stock investment. And this is the risk-return trade-off. And when your risk increases, then you would demand more from your investment. And it can be summarized into this graph. So here, on the x-axis, you have your investment risk. And on the y-axis, you have your expected return from the investment. And even if there is no investment risk, still you want to have some kind of rate of return, the basic return, because you are giving up the present to have the future. Therefore, you must have a higher return in the future. So that's why this is not zero, but a certain positive number. And then whenever your investment risk increases, and then you will demand more. So suppose that through some analysis you found that there is a project and the risk of the project is at this level. However, the return from the project is at this level. And then if you point that into this graph, you will find that this is here below a certain level. So this is my acceptable minimum marginal rate that I'm going to have for the level of risk that I'm going to take. So if this is here, then it means I'm going to take this risk, this much as this risk, but my return is only that. So basically, for this level of risk, I want to have at least this one. So this is the minimum I demand for an investment project. And it is below that level, so therefore, I'm going to reject this project. However, now let's think about a new project and say that the risk is higher, so the risk is here. And then we found that actually the return is very high, so it is here. And then if we plot this, then this is at this point. And you do not just compare the risk here. For the first project and the second project, if you compare them, you can obviously see that the risk is higher for the second project, but that will not be the reason that you take or not this project. Your decision should be based on the return compared to your risk, not the risk in overall. Therefore, you are going to compare the return when you are going to have this kind of risk, and it means actually because I can accept this return at minimum, it means I will have a higher return from the same level of risk. So even though it seems more riskier project, you are going to accept it. So conclusively, you are going to reject every investment below this line, but you are going to accept every investment above this line. So in this shaded area, you are going to accept it, and then you are going to reject everything below. So that's the meaning of this market line. And now we realize that we need to have a higher return if we are going to have risk in our investment. And then how can we incorporate this into our NPV method? It is possible by adjusting, changing your discount rate. So in the last chapter, we thought the discount rate is a given information. So we didn't think about the meaning of the discount rate. However, now in this chapter, we are going to set an adequate level of discount rate first, and then we are going to make decisions based on the discount rate. So therefore, here we are talking about the discount rate, which is risk adjusted. And this means if you have a higher risk in your investment, then you have to apply a higher discount rate. And while if you have a low risk investment, then you have to apply a lower discount rate. And the reason is because we have a risk return trade-off. So let me show you an example. So suppose that there is a stock and I can buy it at $10 per share. And let me just assume that I know the price tomorrow and I expect it should be $12. And then I want to check whether this is a good investment or not. And this is only possible by applying the NPV method here. So if my discount rate is 10%, I'm going to write down the formula like this. I have I have to spend $10 today. So therefore I have a negative cash flow, and I have $12 tomorrow. So this is a positive cash flow. However, this happens in the future, so I have to discount it with respect to my discount rate of 10%. And then if you do the calculation, you will get the NPV as 91 cents. So it means it is profitable, so you are going to invest here if your discount rate is 10%. However, the result will change if your discount rate changes. For example, if your discount rate becomes 5%, what happens is, even though you have the same cash flows, 10 and 12, the result changes. Now you have minus 10 and plus positive 12, but now you have to discount the future cash flow with respect to 5%. Then the NPV will become $1.43, which is higher than the original NPV. And the increase in the NPV occurs because now we think differently about the future cash flow. So in the first case, we think that the future cash flow of $12 worth of approximately $10.91. However, now in the second case, we think the future cash flow of $12 is worth of $11.33. So now we are giving more weight to the future cash flow when we have a decrease in the discount rate. And the opposite will happen if you have a higher discount rate, 15%, and then the NPV will be only 43 cents, which is lower, and it is very close to zero. So eventually, if you increase the discount rate further, then NPV will become negative, and then you will reject this kind of investment. So when you increase the discount rate, what happens here is that you do not want to give up the current consumption, and you want to enjoy it today rather than investing for the future. So this is because you do not want to have uncertainty in the future. So that is why when we have more risk, we need to increase our discount rate, and the opposite will happen in the other case. So when we have a lower risk, we are going to have a lower discount rate. When we have a higher risk, we are going to have a higher discount rate. So this is, so far we talked about the investment criteria, and still you can have your own point of view about your own discount rate, because everybody has different feelings about the future, so you can have your discount rate by yourself. For example, some people may have 11% discount rate, while others have, say, 13% of discount rate. And it depends on yourself whether you like risk or not. However, because now we are trying to manage a company, running a business, and it means we need a more objective way to calculate our discount rate, to get the discount rate which is more correct for our firm. And that methodology is known as the weighted average cost of capital. So we are going to learn about this. So we were talking about the discount rate, and for the firm, we need to calculate the weighted average cost of capital. So what is the meaning of the cost of capital? So the cost of capital is the firm's financing cost. And there are two types of investors for a firm. Creditors, who are giving you the debt, and also the shareholders, who are giving you the equity. Therefore, you have two groups of investors, and because they are investors, they have their own perspective about investment about their risk. So they want to have a certain level of rate of return from the investment into your company. So therefore, they will demand certain profit or the return from you, and therefore, from the firm's point of view, this is the cost because you have to give certain money back to your investors. And from the point of view of those investors, this is an opportunity cost because now by choosing your company as their investment, they are giving up alternative investment opportunities. Therefore, they may have chosen your company if they had a belief that your company is the best one among other alternatives. So therefore, their opportunity cost will determine the level of rate of return for the investors. And in reality, because we have cost of capital for the creditors and cost of capital for the shareholders, we have to find a way to combine those two groups of people into one, and that is known as the weighted average cost of capital. So here, the basic idea is that we are going to make an average between creditors' cost of capital and the shareholders' cost of capital. So here, the KD is the creditors' cost of capital, and the KE is the shareholders' cost of capital. So it seems very difficult to interpret this formula right now at this moment. So let me explain through an example why this should be your cost of capital. So suppose that there is a XYZ company, and this company has debt of $100 and equity of $200, and their tax rate is 50%. And because you are a company with debt and equity, you have debt holders, creditors, and you have equity holders, shareholders. So they are given information about their opportunity cost, and creditors' opportunity cost is 10%, and the shareholders' opportunity cost is 20%. We are going to assume it without finding out why. And then the company needs to think about what to be returned for them. And the first thing is that the creditors, the debt holders, demand a certain level of income for them because they have invested their money, and they expect to have at least 10% because they have gave up certain other opportunities, and therefore this is the minimum they want to have from your company. And because the total amount of debt is 100, the expectation about their return is $10 in the next year. However, not only giving them, but also you have some benefits by having them. As we learned in the capital structure, there is a benefit when we have some debt in our company, when we have more leverage. This is known as the interest tax shield. So by having that, our tax expenses will be reduced as much as the interest expenses. So it can be the amount of the interest tax shield can be calculated by multiplying three terms: the debt amount, your interest rate or their opportunity cost, and finally the tax rate. And it gives the interest tax shield of $5, so you gain $5 additionally. And finally, you need to consider your shareholders, and shareholders are expecting 20% return, and their investment was $200. Therefore, they want to have at least $40 from their investment into this company. In overall, by summing these three things, we can say that the corporation XYZ needs to have at least needs to earn at least 10 minus 5 plus 40, which is $45. And what were the sources of their return? Their assets. Their assets are the sum of the debt and the equity. Therefore, they are generating 45 income out of 300 assets. And therefore, their rate of return at minimum should be 15% because 45 over 300 is 15%. And this result is nothing but the formula I just described before. So I first calculate the creditor's minimal demand about the return by multiplying the debt and their opportunity cost, and I deduct the interest tax shield because I actually can save some money by having the creditors. So that can be here by considering the tax rate is 50%. I have a tax shield of certain money. And finally, I have shareholders who demand 20% return. And the equity amounts to $200. So I calculate this. And then I divide this with the overall asset, the all total assets, which is the sum of the debt and the equity. So here, I have 1 minus t, the tax rate, times the creditor's opportunity cost or the cost of debt times debt plus cost of equity or the shareholder's opportunity cost times equity size divided by debt plus equity. And I can make the second version of the formula by distributing this. So it can be rewritten as 1 minus t times kd times d plus e d plus ke times e over d plus e. And here d plus e is asset. So I can write it as A, and I can write it as A. And so this is the debt to asset ratio, the leverage, and also equity over asset is 1 minus debt to asset. So I can write it like this. So it means that if your debt amounts to 20% approximately on your asset, then your equity will amount to 80%. So I put more weight to the shareholders. On the other hand, if I have 70% of debt and I have only 30% of equity, then I put more weight on the cost of debt. I think more about the creditors than the shareholders. So in that sense, this is the weighted average. So I'm taking the average between the cost of debt and the cost of equity, but I give some weight depending on their size. I give priority to, I give more consideration when I get more money from one of the group. And in practice, we have more problem because in the previous example, we just assumed that the opportunity cost is given and the opportunity cost is given. However, in practice, we need to figure this out from the market information. So that will be our main task in this chapter. So in the next week, I'm going to explain how you can obtain that and that. Okay, so that will be our point of the lecture.